Hello all Inderes.fi viewers and listeners. Rapala released its H1 results this week and we'll be going through the report with the company's CEO, Cyrille Viellard. Welcome, Cyrille, to the interview.
Thank you, Thomas, for hosting me and allowing me to give to our investors a deeper insight on how we're doing and where we're going.
Always a pleasure to host Rapala and hear about your business, but if we start off with the big picture, how would you describe H1 from Rapala's point of view?
So H1 has been relatively good for us in when we see the overall macroeconomic situation, which has been very turbulent, and where we have been able to succeed is through category extensions, product innovation. We had that's really what has driven our success in this turmoil, to a very difficult environment.
Yeah, and well, from an analyst point of view, what really stuck out to me was your performance in the United States. Strong growth there. What's behind this performance?
So the US is our locomotive at Rapala, as you know, and we've had a good start with a good winter, as I had already previously underlined. We're strong, very strong in winter overall, and winter was good. So the after season, the early start of the year was good on our ice fishing, and then on the open water, we are growing in new categories. Crush City has been a blast. It was a massive success in the launch, and as a second year, it's a continued success. Really, our customers really. I was at ICAST last week. Say we've nailed it. And on the 13 fishing as well. Last year was a reset year. And this year we streamlined the range, focused on a nice combo range, and it's been very successful. One last thing, we planned well our season, bought early, really allowed all our category managers to make the best out of this season, and we had exceptionally good fill rates. So every possible sale we tried to get in that first half.
And you did a good job chasing that, but during the operating environment, or during the first half, the operating environment changed quite a bit with the US tariffs coming on board in April. How would you, from your point of view, how did that change things?
That's been a headache. For everyone. It's been very time consuming for all the teams to make the right calls. It's very tactical. You need to be fast to get the most out of every situation. As of now, it's been all the decisions have been taken, have been the right decisions, and it's been painful, but in a reasonable manner.
Yeah, and one of the things President Donald Trump is trying to achieve in the States is local manufacturing. How do you view local manufacturing from the fishing equipment industry's point of view? Does it make sense to invest into manufacturing in the States?
It's still too early, and it's still there's too much uncertainty, and it's too early to make such calls. What we know is that, and this was given to us by the American Sports Fishing Association last week. For example, more than 90% of fishing nets are sourced from China, more than 90% of rods, more than 60% of hooks. So this will not, the supply chain is highly integrated, the suppliers, the sub-suppliers, so you don't start an industry overnight. You need some horizon, a bit some stability. So all options are on the table, but a manufacturing move to the United States is not on the agenda today.
And I can imagine you probably have not seen competitors go ahead with investments into manufacturing in the United States.
Right now, not really. There was, at the iCash show, there was one rod machine builder, but most brands I talked with right now, it's a wait and see, and trying to make the best moving from one country to the other. The unemployment rate in the US is very low. A lot of our products are very labor intensive because we manage a lot of different SKUs. And so when you have a sector which has a lot of diversity with low MOQs, automation is complex. And so you rely more on lower labor cost countries. And so you don't, industrially also, we are not set to start production in high cost location.
Okay, got it. But from a sales perspective, how was H1 from the rest of the world's point of view, or your other markets?
So North America, as said, was strong. Canada as well, strong. North Europe in fishing has been good. Winter sports has been quite poor, as you know, and in winter sports, we're very Finland centric. So if there's no snow in Helsinki, it's more challenging for our cross-country skiing business. But fishing is going well. All the changes we've done are bringing results. Continental Europe is slow. Germany, Italy, France. The heat is hitting also our leisure. The extreme heat of this summer is affecting our sales. Latin America is good, and Asia Pacific is also challenging.
Yeah, so it's really a mixed bag currently. Got it. But looking at your numbers, one thing that really stuck out to me was your cost structure, because that was a lot smaller than I would have expected. So is this something you're able to maintain?
One thing, maybe there's a lot, we've been, and my predecessors, not only I, but we've been doing some cost adjustments in the last 3 years. We did it with the previous CEO, and we've continued. And actually, there's a lot of inertia until you really see them, because you have contractual obligations, you have you accrue for some things, and we're seeing now really the impact of all the efforts of the previous 2 years. Yeah. Probably that's we asked ourselves the same question when you raised that question to us, and that was the most obvious answer to us. That so when you cut fixed costs or you reduce your costs, there's inertia between when you announce it and you have the full year impact,
and a lot of gradual impacts slowly showing up over time.
So the costs, our cost base now is what it is, and this will there's no reason why this should evolve in the coming months. So that's the new standard, and we're still working to reduce our break-even point, to be more agile. So, but again, we see that actions take time before you get the full impact.
Yeah,
you see it in the P&L.
Yeah, but in the report you reiterated guidance for this year, and in March when you gave out the guidance, you said that it reflected the current operating environment, which got quite a lot of trickier after the report in April. But how would you describe your guidance now? Because from an analyst point of view, looking back, it seems quite or somewhat conservative considering how strong your H1 numbers were?
I think you need to be, our H1 is solid, but not exceptional. I think we can do better, not tomorrow, but on the mid to long term, our normalized profitability should be higher than what it is. So I don't see, it's a question of interpretation. I see myself today in line. Our EBIT in percentage of sales is 6.9%. And that's not, it's for our industry, it remains low. It's much better than last year, but it's an improvement, and it remains figures that are not like wow. I would say it's that's why I don't feel conservative, and then the second half has a lot of uncertainty. So yes, our first half is good, but as you know, our turnover is much larger in the first half as we sell in to the stores. They are now, the sellout is now, and we have a softer second half, which will be driven by winter and then autumn predator fishing, but it's less, and southern hemisphere, but still it's not the level of the first half.
Yeah. Well, if we move on from here to your financing structure, you mentioned in the report that in the next 12 months you're aiming to refinance your balance sheet. How do you approach these negotiations that are coming up next year?
Well, we right now, until now, we've been very humble. We wanted to show that our business model is resilient, and we're showing that also in turbulent times when other consumer goods companies are more hit than us, and we show that actually our teams, our business model is actually very robust, and we had to prove it. And I think that first half shows that when in big stormy times, actually our model delivers. Focused on consumables, that means it's less exposed to investment products. Our manufacturing, the strength of our brands, our expertise with our team. So that's a very efficient machine. And so my goal now, and I expect our financing community, now that they've seen that we are robust, but the risk related to our business is lower than they might have assessed, that we need now to have a bit of oxygen. And that will be the discussions in the coming months. And we've had very good partners here in Finland, and I really hope that they will, with our numbers, say, yes, we believe you, and now we need to give you a bit of a room so that we can have a bit more of a horizon.
Yeah, because currently your cost of capital is high. You don't get around that. So I can imagine once you're able to refinance, hopefully at a lower rate, it provides you quite a lot of new flexibility.
Correct. We are right now really focusing on low-hanging fruits, maximum return, and we're delivering. We need to have a little bit of help from our financing community now that we've shown that we are trustworthy. Trust was key. I think we have, in this first half, we have restored trust. You can trust Rapala to deliver. It's solid. And so now, give us a hand,
And in the report, you mentioned that you aim to, provide investors with a new strategy in H2. Is there something you can tease us investors with at this point? What's going to be some topics in the upcoming strategy period for 26-28?
It's a follow-up of the transformation as a house of brands.
Yeah.
That's really, it's continuing. The Rapala brand is our number one asset, as I had underlined. And we now have brand leaders, and they are building strategic plans. And this cultural change is successfully happening. We're having. I'm really happy with the transformation that we are experiencing. It's so that would be the core of our strategy is this house of brands, and with brand leaders that are entrepreneurs and build business plans on their brands and the markets that they address.
Yeah. And looking forward, how do you see the future of Rapala? I can imagine some investors having speculated about some bigger acquisitions or mergers when you had Sycamore Partners previously as a owner, but they recently flagged their ownership stake decreasing below 5%.
Yes, so the Sycamore investment was quite a significant investment in Rapala when they took a 20% share. And as history tells us today, you can see that it was unwanted, although because it did not go forward. And having an unwanted investor, which is also an industrial party, creates a lot of uneasiness in the teams. They have been very fair in the way they have acted as a shareholder of Rapala VMC. Nevertheless, it's not comfortable to have your competitor with whom you don't see synergies being invested. So the fact now that they have almost completely pulled out brings clarity also for all our stakeholders, employees, that this project will not go forward, and so that's pretty positive. The fact also that volumes traded in our share are relatively low, and you have such a significant shareholder that did a block deal that had to exit, probably, I believe, that I'm not a specialist, affected our share price that they had to pull out with significant volumes.
Yeah. Thank you, Cyrille, for the interview, and have a nice rest of the summer.
Thank you very much, Thomas, and I hope you can go fishing.
For sure.
The summer. And the weather is good, and actually business for North Europe is continuing to be good. So I wish everyone a good summer in tight lines.
That's life.